In this video, traders, this is part 2 of useful trading clues from the open. Stay tuned. Hey traders, warm welcome to you. So if you've just come here and you haven't seen part 1, go and check out part 1 where we talk about the position of the open and the range of the open. In this video, part 2, we are going to look at the response of the open and the behavior of the open. These are getting us useful trading clues from the open that we can decipher and we can use as mounting evidence to either confirm or negate our trading hypothesis. So very quick summary. If we are looking at the open, and by the way, this could be the open, like I say in part 1, of anything. It doesn't necessarily have to be the New York Stock Exchange bell. It could be, let's say, the Asian session starting in FX. You know, whilst there isn't a specific bell, it's when things start happening. People are at the desk. Other related markets start opening, start trading. We get money flow back and forth and through the whole thing. So we looked at position. Where's the position? We looked at range. What's the whole range relative to prior days? Now we're looking at response. This is where we start getting interesting, and we're going to kind of maybe develop a few setup ideas from this. So let's say we've got a huge level of resistance up here, and assuming everyone here knows what resistance is. If not, that means you're probably a brand new trader. Welcome if you are. Go and check out some of the videos that we've done on resistance. Anyway, we're coming up to some resistance, and we want to see what the response is to that. So the opening 15 minutes, opening 30, opening hour. Okay, we've looked at the position, we've looked at the range so far. We're looking at the range, we're saying, you know, range is reasonably big or it's reasonably small. More importantly, how is it responding to key levels? So it could be resistance, could be a prior day's high. That's something that often comes into play, right? The prior day's high is often tested at the open. Let's see how it responds to that. How does it respond at a whole number? How does it respond at any key level there? So what are the options we've got? The options are, okay, and also we've got a couple of variables here. So let's assume we open here, and let's assume that our ATR, average true range, or our expected, let's say our expected range in the first, let's call it 15. Let's just hypothetically put an example together here, guys. 15 minutes, we're expecting the range to be 100 pips, say, okay, and we're opening here. So we've earmarked in, or we've kind of marked in on our charts, and this kind of thing I'll do. There's 100 pips, there's 100 pips. This is for argument's sake. It's going to be less than that generally, but we know average range, what we're expecting the market to do or where it could go in the first 15 minutes. Now, don't forget, that's if it goes from low to high. That's kind of the maximum we expect. Very often, or most of the time, it's going to come up a little bit, fade down a bit, and that will be 100 pips. So we're looking to where is that 100 pips going to be? So now, let's say our key level is hit right in the middle of the thick of this ATR. Okay, now we can take evidence from the prior day and say, well, we're quite stretched, we're on day 3, blah, blah, whatever it may be. I'm looking to fade this. And your theory might be, well, actually, if we get up to here, let's say that's 50 pips, we could get up to here, and if we do 100 pips normally in the first hour, my target's going to be down here, right? Because that's my 100 pips, that's my expected range for the day. So if the price response to that key level is to pause there, then assuming this will not break, everything else being equal and normal, we are going to reverse and come back down, and we're going to do that 100 pip range. So my setup for the trading day on this would be, okay, this is my key level. I'm going to fade a fake through that comes back. And again, we're not kind of going to go into intricacies of setups and pure rules in this video, guys. We'll just kind of keep it broad so we can keep things moving. If you like this kind of stuff and you want to go into deeper stuff, then make sure you hit that subscribe button, because we'll really be digging into some stuff later on in the videos. Right, so we push up, we push through, and let's say we fade. Now that's a nice setup, right? It's a real nice setup because you've got your key level. It's within that range. It's a decent thick level for whatever reason that may be. If it fails, I know my stop can be reasonably above the high, but I've got an obvious target because I know that the range is likely to be 100 pips. That's my obvious target, and I know when it should hit that in the first 60 minutes. Ticking a lot of boxes for me, that kind of thing. This is why this is one of my preferred trades at the open. And then if you're a swing trader as well, how is this helping? Well, let's say your thesis is short, for example, on this stock over the next few weeks. Perhaps this is the trigger to get you in short. So you can now use a 20 pip stop, a 30 pip stop, or whatever it is, and then looking for 500, 600 pips move further down the line. So that's the thing. So let's go back to the point of response. So we're looking at the price response here. And additionally, if we fail above that and we start dipping below and we've got the short thesis, that's great. But let's not forget, if we rip up straight away in the first 15 minutes, and let's say we're looking at 60 as our open, we rip up straight away and start holding above it, where do you think this sucker's going to go? Likely it's going to go and hit our 100 pip target. That's going to be the low. So our range for the first 60 minutes is going to be 100 pips. Where's our obvious first target going to be? Yeah, you're right, it's going to be there. And we've got loads of weight on our side. We've got the expected range is on our side, check. We've got the fact that we've got momentum very early on, check. We've got the fact that it's responded to a key level with aggression, i.e. it's blasted through and held above, check. We've got a lot of reasons to take the deal. There's no real negative signs on that. Of course, we're always going to use stops because there's never going to be 100% accuracy, but it gives us a lot of weight to play this trade. Similarly, let's assume nothing much has happened prior, okay, but we've kind of crept up and we're here and you're thinking swing trading for a long. Now you see this kind of characteristic at the open, really aggressive open. We'll look at behavior in a second because we're kind of touching on it a bit now. Pushing through, holding above early on, expecting that actually the demand's going to carry on and we could have a good trend day here. And this is the precursor for a trend day. It's setting the stall out for a trend day early on. So that's a response. And of course we can flip that on its head for the other way around. Behavior. So behavior is what happens in that first 50 minutes. We talked about kind of one-way trade here, haven't we? We've talked about, okay, if we rip through and we hold, then that's all very well and good. But very often, and you can get whipsawed by that if you're not careful, we see what we perceive to be strength, extreme strength, just immediately fade away again, which is why we need to see the patterns that do indicate true supply-demand imbalance. Those are the real tricks there. We don't want to see, and by the way, guys, this used to be something that I had to work on a lot at the open, getting sucked into what I perceived to be momentum, only to see it fade straight away, getting frustrated. So I came up with a few methods and strategies of kind of holding back. Yes, does that mean you've missed stuff? Of course it does. But if it means I'm not getting caught out by all these silly whipping about, then that's a win for me. And so you want to see, if let's say you're looking at the first 60 minutes, you're on a 5-minute candle, or if you're the first 15 minutes, you're on like a 1-minute or 3-minute candle, adjusted to suit you. You will need to see how the price responds. What we don't want is behavior, and I've said this terminology before, where we get dirty candles. In other words, we get one green, we get one red, we get one green, we get one red. Yes, they're not going to all look like that, but just no clear pattern. And when you look at it and you're looking at this little window of candles, you're like, this is just a mess. If you get that, you need to say all bets are off until I see something clean. I need to see something clean. In other words, I need to see the market drive up. I don't mind it pulling back. A pullback's nice and healthy. I want to see the response of that pullback. What's the behavior when we pull back? Is it immediate demand coming back in again, or is it just sitting there doing nothing? If it's just sitting there doing nothing, we can hypothesize that initial drive was nothing more than just someone getting some orders done with some urgency. He goes out for brunch. He's just getting his order done and now he's off. Okay, so we need to see nice clean patterns. And if you go back, right, and you look at all your good opens, so to speak, and you look at all the charts, I feel like I've looked at thousands of them, but the good ones all exhibit similar characteristics. They all exhibit almost little mini days in that hour or that 15 minutes. So you can almost look at it and go, that looks almost like a strong day trend. If I had a whole day's worth of trade there, it looks like that, because you see the supply demand imbalance. You see it driving up, it backing off. You see it driving again, maybe does a double top, fails a little bit, test a low, get a wick in. That's the kind of stuff we want to see. We don't want to see, like 50% of the candles looking good and 50% looking dirty candles. We just don't want to see that. So the behavior of the market, if it's ripping up and ripping back and ripping up and ripping back, forget about it. We've got plenty of days in the month to get on something, plenty of markets within that day. We've got hundreds of opportunities. Just because you've had a perfect plan, a perfect thesis, a perfect idea to trade this open or to have it set up, it doesn't mean that you have to force it on it. The best thing to do is have that loose thesis and plan, see what the open does, check your position, check your range, check your price response to the key levels, check your behavior up to those key levels. Is it grubby? Is it firing back and forth? Is it kind of testing? Is it strong? Is the supply demand imbalance obvious? And then place your trade. Then put that idea into practice. As long as you've got a good place to manage your risk and to put your stop loss in, and you've got an obvious, sensible place for initial targets or further targets, whether that's day or swing trading, then you're good to go. Anyway, guys, useful trading clues from the open. If you like this kind of stuff, a thumbs up is much appreciated, as is your subscription if you're not already. And if you are ready, thanks for your support, guys. Take care. Bye-bye.